Hello and welcome back to another video. Today I'm going to be explaining how DSCR loans work. Now by the end of this video you're going to understand exactly what they are, different types you can get, how you can qualify, as well as the pros and cons of these loans. So make sure you watch this all the way to the end so you don't miss any important details. So to start with, what is a DSCR loan? DSCR stands for Debt Service Coverage Ratio. And this type of loan is a specific type of loan that businesses can use to finance the purchase of multifamily and commercial real estate. DSCR loans are unique in that they are based off the amount of cash flow a business generates each month compared to the amount of debt service payments the business must make. In other words, a DSCR loan is a type of non-qualified mortgage loan designed for real estate investors. This loan allows investors to secure financing for their investment properties based on the property's ability to generate sufficient income to cover the mortgage payments and other debt obligations. So now that we know what it is, what different types of DSCR loans can we get? To start with, there's the fixed rate DSCR loan. In fixed rate debt service coverage ratio loans, borrowers have a predetermined interest rate that remains constant throughout the loan term, resulting in a consistent DSCR ratio. This is an ideal option for long-term investors. Next up, you have adjustable rate DSCR loans. And these loans have an interest rate that can change over time. And finally, we have the interest-only DSCR loan. And these loans require the borrower to only pay the interest on the loan for a certain period of time. So how do we actually qualify? To start with, you want to have a DSCR ratio of 1 or higher. The debt service coverage ratio is a financial measure used to assess an entity's ability to meet its debt obligations. It's calculated by dividing the net operating income or cash flow by debt obligations. You also want to have a down payment of 20 to 25%. 20% for experienced investors and 25% for first-time investors. You also will need a credit score of 620 or higher. And a good credit score is essential for securing a DSCR loan. You must have property appraisal and 1007 rent schedule because an appraisal is required along with a rental income assessment. You must have a loan to value of 75 to 80%. And the maximum loan to value ratio is 80%. And finally, you must have some cash reserves. Having cash reserves can be beneficial when applying to a DSCR loan. So now that we know exactly what it is, what are the main benefits associated with it? To start with, you have no personal income consideration. One of the significant advantages of a DSCR loan is that it does not require employment verification, disclose any leases, or present proof of income. Instead, the lender is only interested in the cash flow generated by the subject. You also have flexibility. DSCR loans provide great flexibility, allowing real estate investors to find alternative ways to fund their project. They are also more flexible than traditional commercial mortgages. The type of financing can offer more flexible terms when compared to traditional property loans, and this might include longer repayment terms and lower interest rates. And finally, it's easier qualification. DSCR loans are typically easier to qualify for than traditional loans, as lenders do not need to verify the borrower's personal income. So now that we know about the benefits, what are some of the main disadvantages? To start with, higher interest rates. DSCR loans tend to have higher interest rates than conventional loans, largely due to the increased risk the lender takes on. There's also prepayment penalties. While most mortgages no longer charge prepayment penalties, they're still quite common with DSCR loans. There could also be a higher down payment. The down payment required for a DSCR loan could be higher than what's required for other types of loans. Also, the approval process for a DSCR loan can be longer than other types of loans. And finally, you must consider additional expenses. When calculating the DSCR, you must consider additional expenses such as maintaining costs, property taxes, insurance, and management fees. So this has been my video explaining how DSCR loans work. Hopefully now that you've watched this video, you have a good understanding of how they work. And hopefully this video has helped you if you're looking into getting a DSCR loan. So I hope you found this video helpful. Thanks for watching.